Today we're going to focus on the Russell 2000 Index, or small cap stocks. First of all, we are DeCarly Trading. We're a futures and options brokerage service. We're located in Las Vegas, Nevada. If you're interested in trading futures and options, we specialize in that service. We are a boutique brokerage, and we'd like to think that we are extremely efficient at offering just futures and options, so we don't do stocks. A lot of people ask us that. We focus on what we're good at. Just a reminder, there is a substantial risk of loss in trading futures and options. Trading is not suitable for everybody. So earlier in 2019, many analysts were calling for small cap stocks to outperform large cap stocks due to what was perceived as an undervaluation, but instead we're seeing the sector continue to stall. If we're to believe the conventional wisdom that small cap stocks are the market leaders, then this should be reason for concern. If you're unfamiliar with the Russell 2000, it's a stock index comprised of 2,000 of the smallest companies in the Russell 3000 index. The Russell 3000 index is made up of the 3,000 largest U.S. stocks. These 3,000 stocks represent roughly 98% of the marketplace. So in other words, the Russell 2000 represents all but the largest 1,000 and the smaller fringe stocks. So again, the Russell 2000 is basically the benchmark per se for small cap stocks. Because this index includes smaller cap stocks, it's extremely volatile and it's highly speculative. The PE ratios can be anywhere from over 100 to into the 40s or 20s. So the PE ratio can be extremely high, or it's generally not extremely low, but it can be. But it can be much higher than the S&P. Let's just leave it at that. So accordingly, because of the volatility and because of the speculative nature, this is the first place that many traders and investors look to add or subtract risk from a portfolio. As a result, the Russell 2000 often leads the market higher or lower. For instance, many tops and bottoms begin with a turn in the Russell. If you look at this overlay chart, we've got the S&P in green and the Russell 2000 in red, and you can see there's a pattern. A lot of times when right before the market corrects, the Russell starts to weaken. It doesn't make the higher highs the S&P makes. It starts to taper off, and then eventually the S&P follows suit. So obviously this pattern isn't foolproof. We're not going to be able to look into the future and see exactly what's going to happen with the S&P just by eyeballing the Russell, but it's something to be aware of because this pattern does happen over and over again. Looking at a chart of the Russell, we can see that although the Dow and the S&P have spent recent weeks making new all-time highs, the Russell can't even manage to break above the 2019 highs. This is for good reason. Smaller companies tend to be focused on growth and generally carry large amounts of debt. Leverage is awesome when things are going great, but if the economy softens, those are the companies that basically have a noose around their neck. So investors look to, again, add risk and subtract risk from their portfolio with these stocks because they are the riskiest. You'll notice that not only have we not made new all-time highs, the Russell actually hasn't even recovered from the losses that occurred starting last fall and extended into the Christmas season. The S&P, as we know, have recovered all of those losses and then some. But the Russell's only regained about 75% of that drop. If you're a Fibonacci follower, you might recognize that as almost being the 78.6 level that is pinpointed as resistance based on the Fibonacci ruler. Further, following the initial snapback rally in 2019, the Russell 2000 has essentially been range-bound. It's lacked any bullish momentum to break toward new highs, and it hasn't even managed to get into overbought territory. You can see the RSI and the Williams percent R at the bottom of the screen. Williams percent R is a quicker indicator, so it's been showing overbought a couple times here and there, but we rely more on the RSI, the relative strength index, and you can see all year it has yet to get into overbought territory. This shows you that there's really just a lack of buying momentum and a lack of interest. Some believe that this suggests that the small caps will outperform as we go forward. They're looking for the small caps to catch up to the S&P. I tend to think that this might be a sign that maybe the S&P is due for a pause at minimum and maybe even something more. So just to confirm, we're not looking for a crash, we're not looking for the end of the world or anything to that nature. We're simply saying stock market might be a little overdone here. We've had a great year, and there's nothing wrong with being cautious going forward to see what happens. If you're interested in trading commodities, trading futures and options, we'd love to have you. You can find some information on our website, decarleytrading.com. If you want to just learn, there's videos and articles and all kinds of interesting resources on the website. They're all free to access. We want you to learn before you get involved. We want you to know what you're getting into. If you're a reader, Higher Probability Commodity Trading is available at any major book outlet. You might also look for A Trader's First Book on Commodities. And once again, we are DeCarley Trading. Hopefully you enjoyed this. If you have any questions or if there's anything that we can do for you, let us know.